China suffering from a crisis of confidence, or does it go much deeper than that?
Look, I think there's a whole series of macroeconomic issues that we've all discussed in China. I think the critical issue from an investor perspective, however, is moving beyond the macro and really looking at elements of the Chinese economy as well as other regional markets that are showing significant performance. It's very conventional wisdom to talk about the macro weakness. However, focusing on the fact that China EV stocks, as an example, are up 68% year to date. If you look broader than that in the Chinese economy, Chinese digital economy stocks are up over 50% on a year-to-date basis. And you're seeing similar bottoms-up, thematically driven investment returns in multiple markets around Asia. So I do think it's important to get beyond the macro, where you're still seeing a very noisy data set. And ultimately, for China, you're still seeing significant negative GDP revisions. I don't think we're past the end of that cycle yet. And so again, moving from the macro to micro is, I think, critical for investment returns here.
James, we're seeing China being a bit more aggressive in terms of supporting the property sector, for instance, support the economy. Does it move the needle for you?
So I think there's, again, two elements as always. One, the real economy. Two, the stock market. From a real economy perspective, some of the moves will have a limited amount of impact. For example, if you start to move rates around, we don't think that that will improve new home sales. That might be a slight boost to consumption. So we have to get very detailed as we start to analyze the actual impact of some of these measures. From a broader China property perspective, the JPMorgan view was that you'd see up to 13% sector upside off the back of these new initiatives. We've now seen that. And again, the critical thing to do here is to focus on the bottoms up. You're seeing property managers with 6% improvement in earnings off the recent quarter, developers 6% reduction in earnings. You're seeing significant stock price performance differentials on the back of earnings beats versus misses to the tune of 8-9% on an intraday basis. And so the stock market is reflecting reality in terms of the idiosyncratic performance of individual companies.
So what else do you need, James? I mean, we saw how money was getting into the property sector in recent days because of those measures. Also, expectations of more stimulus. We've seen cuts in mortgage rates, down payments. What else do you need to see?
And I think we heard it earlier in the program. I think you need to see a restoration of investor and retail confidence on a more broad-based perspective in China. The incremental moves that the Chinese government is taking to shore that up are a good first step. I think ultimately we'll need to see more on the policy front to continue to shore up overall economic growth in the Chinese economy for investors to start to step in a real way. I do also think there's a fundamental long-term concern that you have a significant supply-demand mismatch. The demographics of China are very clear. Urbanization is not done, but we're clearly far into that conversation. And so the idea that you can continue to drive the economy 30% of overall Chinese economic growth out of the property sectors is probably not a realistic conversation anymore. So we need to look further afield into services, into innovation, into new elements of the economy, which is one of the reasons why you're seeing investors so excited and such strong share price outperformance in the Chinese electric vehicle space, in the Chinese digital economy space, as we just stated.